Today I'm going to talk about leveraged ETFs, not just any leveraged ETF, but leveraged S&P 500 ETFs, and I'll show you the best 2 times and 3 times leverage winners. Now there are numerous types of leverage ETFs. There's sector-based leverage ETFs, and there's also individual stock leverage ETFs right now. There's also one that just opened up a day or so ago called Ultra Bitcoin ETF that's supposed to be 2 times the performance of the Bloomberg Bitcoin Index. So there's all kinds of crazy things out there. And I recently found one that opened roughly in 2024 called the Max S&P 500 4 times leveraged ETN. This is basically 4 times the S&P 500 index. Now here are 4 of the leverage ETFs that I selected compared to the Vanguard S&P 500 index fund. That's the benchmark. You can see at the very bottom, the Vanguard fund, this is a 5-year return, only returned 81%, and all of the leverage ETFs during the same period returned anywhere from 125% all the way up to about 170%. So pretty impressive. However, despite these impressive results, the SEC has released a investor bulletin on leverage and inverse ETFs. It's a warning. This was from August 29th of 2023. It says there's an extra risk for buy and hold investors. Okay, why do leverage and inverse ETFs have extra risk for buy and hold investors? It says that they reset daily. Most of them reset daily, meaning they're designed to achieve their stated objective on a daily basis. Their performance over longer periods of time, over weeks or months or years, can differ significantly from the stated multiple of performance of their underlying index benchmark. This effect can be magnified in volatile markets. What they're complaining about is it'll say 2 times multiple, 2 times leverage, 3 times leverage. Over a year, a 3 times leverage ETF is not going to return 3 times. It's going to be less than that. It's aiming to return 3 times only on a daily basis. So that's their main complaint here. Here's an example. Over 4 months, an index gained 2%. However, a leverage ETF seeking to deliver twice the index daily return fell by 6%. So that's something to be aware of. They also mentioned single stock ETFs, an additional layer of risk. So these new single stock ETFs like the 200% Amazon or the 200% Microsoft, it says there's an extra risk for those because they go up and down a lot more than the market. And here's another one. In leverage and inverse ETFs trading in Bitcoin futures. So I mentioned all those in the intro. Other than the stated numbers not meeting expectations after the first day, what are some other risks with leverage ETFs? Well, the first one that comes to mind is counterparty risk. Now recently during the bank failures, Credit Suisse failed and they had $17 billion in bonds. Whoever held those lost basically all of the money. For example, if you had an S&P 500 swap, I'm guessing that you would probably lose that as well. If we look at one of these leverage ETFs that I selected, the Proshares UltraPro, also known as the UltraPro S&P 500 ETF, this one returns 3 times the daily performance of the S&P 500. If we actually look at their holdings, besides owning just the regular S&P 500, they own S&P 500 index swaps with various banks. And they have Goldman Sachs, BNP, Paribas, UBS, Citibank. Citibank is having some financial problems now. And Societe Generale. So you've got all of these. These are counterparty risks, as far as I know. So if, for example, this private deal that they have with these banks, if one of these banks goes under, it could bring your portfolio with it. So this is pretty serious. And these are not like regular deals that you could buy. These are like specialized deals that they've done just with them directly. You won't see any numbers associated with it. So these are private deals. You know, I don't really know what the terms are of the deal. So I don't believe that they're protected. So in the event that these go under, it could bring your portfolio down with it. I found this on the Direxion website about counterparty risk. Now Direxion says that they try to minimize the counterparty risk by diversifying its portfolio of relationships of swaps and futures contracts across multiple brokers. Direxion will regularly monitor the balance sheets of all counterparties and will suspend or terminate relationships with any organization that, in its opinion or Direxion or its affiliate, shows material signs of insolvency. So that's another risk you have to worry about, that Direxion or Proshares is doing this, you have to hope that they're doing a good job, just to make sure that your investment doesn't fail because of something unknown.
It's gone. It's all gone. Poof.
Now, another one that comes to mind is tracking error. Now, a lot of people in the past have mentioned that leverage ETFs have a high tracking error. That means they don't match the index performance exactly. But from what I've looked at here, it doesn't actually do that poorly. It does pretty well. So if we look at the S&P 500, the daily tracking error is roughly 0.01% with a standard deviation of 0.18%. If we look at this one that I've selected, SSO, Proshares Ultra S&P 500 ETF, one of the more popular ones, it only has a tracking error of anywhere from 0 to 0.02%, but it's got a little bit more of a standard deviation. So it's not in the 1 or 2%. This is just a small amount. It's not that big of a deal. So this one's not a big issue. One that's probably a bigger issue is the leverage ETF rebalancing. So every day it's trying to achieve 2 to 3 times the index. So every day it's probably buying or selling some of these derivatives. So for example, if the S&P 500 goes down 5% one day and it goes up 5% the next day, the index is actually down. It's actually down slightly. So it would actually have to go up like 5.3% after it's gone down because the principal amount gets smaller. So when they start rebalancing this, it can actually creep down. If the index went down 5% and up 5%, and you repeated that pattern over and over, it would start creeping towards 0 over a period of time if you did that enough times. So what happens is the performance starts to drop a little bit because of that. Another con of leveraged ETFs is high fees. For example, this UPRO has a net expense ratio of 0.92%. Now this compares to the Vanguard S&P 500 fund, VOO, which has a 0.03% expense ratio. So over time, this kind of brings the portfolio down slightly. Now with all the leverage, it still tends to outperform the S&P 500, but it makes it more difficult with the high fees. Number 5, we'll have negative returns when the market is flat and the S&P 500 is break even. For example, if we look at the S&P 500, which is this black line here, basically from 2007 all the way to roughly 2013, 2014, the market was pretty flat. It didn't really go up much. You'll see here it says 0 right here on the right. So it didn't actually return very much. And if we actually look at the line below, these are the two leveraged ETFs that I added. SSO was created in 2006. It was the first leveraged ETF. And so I've added this one. And so if you actually look at the orange one here, this SSO, you'll see that it actually went down. Even when the market was pretty flat, it underperformed for many, many years. So this is the part that people overlook, I think, is they don't see that the market could be flat for a while or down slightly. They just see this last 2016 all the way to 2024 where it's done spectacularly. Also, you can see here when the market goes down, this was during the COVID dip, 2019, December 2019. You see this huge dip. Well, the S&P 500 in black, the dip was much smaller. You see how pronounced this dip was with UPRO, which is a 3 times multiplier leverage ETF. Also, if there's large downward index movements and upward movements, it will lag the S&P 500 sometimes. For example, if we look at UPRO here in orange, after the COVID dip, it went down, extra low, and then it dipped up really high, but it dipped down after that. Now, if we actually look at today, it's basically below what it should be today. Now when I added in UPRO, which is the 3 times leverage, SSO is actually the 2 times leverage, not 3. I think I may have said 3, but this is the 2 times, this is the 3 times. Now when we look at the purple, it went down more aggressively during the COVID dip, and it went up more aggressively. And actually it went up so drastically that it's actually higher than what it is now. If we actually look at the peak here, it's above 163%. It's still at a loss from 12/27/2021. It peaked and it still hasn't went back up to that level. That's the weird thing about the 3 times leverage and the higher leverage ones, you'll see stuff like this where you could have a loss. So if you bought into this during the momentum when the stock market was going up and you got near the top part, you bought near the top, you would still be at a loss even today. So that's pretty scary about that part. But if we look at the 2 times leverage one, it's higher now than what it was in 2021. So this one does a little better in that regard. This is from the direxion frequently asked questions. What happens if the value of the index for the direxion leverage ETF is tracking moves more than 33% in a day? The fund's underlying index moves more than 30% on a given day in a direction adverse to the fund. The value would go to 0. But the investment advisor will attempt to position each fund portfolio to ensure that the fund does not gain or lose more than 90% of its net asset value on a given trading day. So it says here that it may not be responsive to the underlying index movements beyond 30% on a given trading day. So that's the downside. If you're just thinking more leverage is better, this is the downside, is that it could move towards 0. Okay, here's another one. Number 9, high volatility may make returns worse or better sometimes. Using this example, the volatility rate, if the S&P 500 returns 0%, so basically break even, the 300% one-year index, if it's perfectly made, it should return 0% the same. But it's showing here if there's a 10% volatility rate, it will be minus 3%. If there's a 25% volatility rate, it'll be minus 17%. Now this is basically the whole year. If the whole year it's 25%. And if it's 50%, it very rarely gets this high, then it would be minus 52%. Now it's showing that if everything was perfect and you had a 20% S&P 500 return, it should return 60% roughly. Well, of course it doesn't do this because it's a daily performance and it doesn't track perfectly. But if the volatility is 10%, this return actually increases. The green ones here actually are good. The red ones are bad. So if the volatility goes to 25%, then it drops from 60% return to 43% return. Now, of course, that's 43% is still better than what you're getting with the S&P 500. So most of these numbers are still better than the S&P 500. Even with the 50% volatility rate, if the index returns 50%, you're getting 59% on this. But you can see how this can sort of change things. So if we actually want to get the above normal returns, it's got to be at lower volatility typically. So like 10%, 25%. If it gets up really high, the returns go down. If we look at the volatility index, the historic chart, we look here, so roughly 20, 25, most of the time it's below 25. You can see that this is back in 1995, got up to about 27, but most of the time it's, below 20, and then every once in a while it goes up to maybe 30. And then during the COVID, it got as high as 66 for a short period of time, but then it dropped back down to roughly 36, 24, and it was at roughly 30 something for a while, and then it dropped back down all the way to around 20, and then roughly 30 for a little while, and it's been lower recently. So they're saying that that's why that the performance has done so well for the leverage ETFs, is that the volatility has gone down quite a bit. What are some of the pros of leverage ETFs? Can achieve superior returns over the S&P 500 over the long term when markets go up. The Vanguard S&P 500 is the very bottom one in red. You can see that when it's gone up even just a little bit, it's basically done well. The leverage ETFs have done well. And when it's gone up drastically recently, it's done even better, the leverage ETFs. Can lose only 100% of investment at most. So you're getting the benefit of leverage without a huge amount of risk. So you can only lose 100%. You can't lose more than that. It's not like shorting a stock where you can theoretically lose an unlimited amount of money, or with a lot of the options trades where the losses could be unlimited. This is limited to 100%. Also, there's tax efficiency with ETFs. If you're holding this long term, it's going to be a long-term gain when you sell it, and it's going to be taxed at a lower rate typically than a short-term gain. Yet, if you're speculating with options, they're typically going to be short-term gains, and a lot of the trading is going to be a higher tax rate than long-term gains. Okay, what would be a good use case for leveraged ETFs? Is there any good use case? When the S&P 500 is not overvalued or overpriced, or when the market makes a major correction such as 10% or greater, then investing a small portion of the portfolio in a leveraged ETF is probably not that risky. For example, if you buy when the markets are going up, like here in 2022, or actually probably now, if you start buying these leveraged ETFs, so whoever bought right here, for example, December 27, 2021, roughly 3 years later, they're still waiting to make money. So either one of these 3 times funds, the SPXL and UPRO are both 3 times leverage ETFs. You can see green right underneath this purple. Both of these are at a loss still. So when the market goes up, if it's overvalued, probably like it is now, for example, if we look at the S&P 500 price earnings ratio, this is a measure of valuation of the stock market. You go back through history, it's roughly anywhere from 10 to 25 price earnings. And that was actually, the 25 was actually, at the high point. And then you get to 2001, if you get near the dot-com bubble, it got as high as 46, and now it's at 28, so it's actually pretty high. And if we look at some other measures, the Shiller price earnings ratio, this is another measure. It's pretty high. It's not as high as the dot-com bubble, but it's higher than it's been in the past. So maybe it's not a good time to buy a leveraged ETF just yet, but maybe if it drops down to 25, this number here goes to 25 or a smaller amount, maybe it's going to be better. If we look at the S&P 500 dividend yield, this is at kind of an all-time low also. Now, a lot of companies aren't paying dividends like they used to, but this is still a decent measure. So in the year 2000, it paid 1.15%. That was kind of an all-time low. That lets you know that the prices are really, really high, so the dividend yield is going to be very low. Right now, 1.36. If you went back to when stocks were fairly cheap, back in the 70s or 80s, it would pay 4.99%, 5.8%. So the stock market's not really cheap right now. So applying leverage to an overpriced market is probably not going to be a safe thing to do. Also, hold a very short period of time or a very long time, 3+ years, and expect the ups and downs. If we look here, and you can see that for many years after it peaked in 2021, it took a while before it's actually profitable again. So if you're buying it and you're just expecting to hold it 1 or 2 years, that's probably not long enough. So it either hold it a few days or a short period of time and buy and sell it, or hold it a very long period of time. But 1 or 2 years, I think, is not enough. If you look at here at this peak, it's been roughly 3 years, and they're still not at break even, whoever bought at the peak here for the 3 times 1. And when we go back further, you saw that there was many, many years where it was basically below the S&P 500 for the leverage ETFs. But over time, the stock market almost always goes up. So eventually it will go up, but you'd have to be patient with this. It's not, and you have to expect the ups and downs to be very great. As you can see here, the ups and downs can go up and down quite a bit. Minus 63%. So minus 63% versus minus 22% for the Vanguard S&P 500. So that's a big jump. So if you had a lot of money in there, expect it to drop down to a low value from time to time if you're using a leverage ETF. Okay, what would be a risky use of leverage ETFs? Well, I would say probably buying with momentum when the market's going up and expecting that it's just going to shoot up like a rocket, and buying with too much leverage, doing the probably 3 or 4 times when the market's overvalued. There's a 4 times leverage ETF. If you bought the 3 or 4 times here, the market doesn't go back up higher, you're going to be at a loss for a long time. holding a year or two and expecting superior returns. That's probably not going to happen. It's going to be a rough ride, and there's going to be a period of years where it maybe underperforms. Okay, so which one of these leverage ETFs is the winner? I have the 2 times leverage ETFs here on the left. So I have the Proshares SSO and the direxion SPUU, which is also a 2 times leverage ETF. You can see here when I select over at the color here, this is the 5-year performance. It returned 152% with SSO. With SPUU, it only returned 125%. I just checked, SPUU was created in 2014, so it's actually covers this whole length of time. This one was actually created sooner. The inception date is even sooner. SPUU the inception date is 2014. SPUU only has a market cap of $166 million, and the trading volume is really low, like 18,000 shares per day, whereas SSO is like 3 or 4 billion or more, and it's millions of shares traded per day. The same with UPRO and SPXL. These are both, the market cap is in the billions, and you're talking about millions of shares per day traded. So even though this one here, SPUU, I think has a 0.6% expense ratio, it's just too small, and you can see from the poor performance that it's not a good one for that category. Now, if we look at the 3 times leveraged S&P 500 ETFs, we have the Proshares UltraPro 3 times leverage ETF, and we have the direxion SPXL, which is also a 3 times leverage ETF. And when we look at the performance between these two, it's kind of a toss-up. So it's 168, 169. If you look over time, UPRO seems like it's above a lot of times, and this one is more recently is up slightly. But I think I would probably give the edge to UPRO just because it has a slightly lower expense ratio. And there's another one. Which one is the best 4 times leverage ETF? Now this is actually an ETN. I'm not sure the difference between this and an ETF, but this is a 4 times leverage ETN. It tries to do 4 times the performance, 4 times the daily performance of the S&P 500 total return index minus applicable fees and charges. So this is the riskiest out of all these. This one, the creation date was December 7, 2023. So this one is brand new. And this one has 113 million market cap. And this one has a 0.95% expense ratio. So roughly in line with the others. But this one is brand new. It's a very high leverage amount. So only time will tell how well this leverage does. I think it's probably too much leverage. So I'm not going to be recommending this one, but it is the winner for the category because I don't know of any 4 times leverage ETFs for the S&P 500. So it wins that category just because it's the only one.
There was a book written, You Only Have to Get Rich Once. It's a great title. It's not a very good book. Walter Gutman wrote it, but many years ago. But the title is right. You only have to get rich once. And why do people, very bright people, risk losing something that's very important to them to gain something that's totally unimportant? The added money has no utility whatsoever. And the money that was lost had enormous utility, and on top of that, reputation is tarnished and all of that sort of thing. So that the gain-loss ratio in any real sense is just incredible. I mean, it's like playing Russian roulette. I mean, if you hand me a revolver with 6 bullets or 6 chambers and 1 bullet, and you say, pull it once for $1 million, and I say no, and then you say, what is your price? The answer is there is no price. And there shouldn't be any price on taking the risk when you're already rich, particularly of embarrassment and all of that sort of thing. But people repeatedly do it, and they do it whenever a bright person, really bright person goes broke that has a lot of money, it's because of leverage.
Now, Warren Buffett makes some good points. Is it really worth the risk of losing your entire investment? Now, leverage ETFs haven't been around very long. The earliest one was created in 2006, so we don't know how well they do with a major market downturn. However, there is a 2 times Ultrabull Profund that was created in 1997 that we can look at as an example. Now, this is not as good as the ETF. It has a much higher expense ratio of 1.52%. And this fund was created in 11/26/1997. And we also have a Nasdaq version that we can compare. The Nasdaq one was also created in the end of 1997. If we compare from the time that this fund was created to currently to see how well it does versus the S&P 500, you'll see some disturbing results. If we look at when it started in 1998, as the market went up in the late 90s, it outperformed the S&P 500, but it couldn't handle the dot-com correction. So as the dot-com bubble burst, it went down below the S&P 500. And even though the market went back up around 2007, 2008, it was still under the S&P 500. And when the market went down again in 2009, it underperformed. It basically took all the way to 2017 before it outperformed the S&P 500 again. 18 years. So basically from here to 2018, it took 18 years basically with greater volatility just to barely beat the S&P 500. And when we go from 2018 all the way to 2024, it's actually at the same level as the S&P 500. Actually, I think it's slightly lower than the S&P 500. So all that extra risk for basically nothing. You're paying higher fees. So this fund is just not very good at all. But the ETF is better, but this gives you an example of what you can experience when the markets go down. Now, when we added the UOPIX, which is a Nasdaq 100, 2 times Nasdaq 100 index. It's not 3 times, it's not 4 times. Look at the results of this. So the results are pretty crazy. So you can see that during the 2000 dot-com bubble, it went up like crazy. And basically the same result. It basically underperformed for 18 years. Luckily, this one went up enough to where it actually beat the S&P 500. But I bet if we add the Nasdaq 100, it's probably not much greater than the Nasdaq 100. So now when I add the Nasdaq index in green here, we see that it still did not perform better than the Nasdaq. So a regular Nasdaq index outperformed this 2 times mutual fund. So the mutual fund is not showing very good results in the long term. And if we go from 1998 to 2003 to see just how much it went down, the Nasdaq 100 fund went down minus 79%. So basically minus 80%. Minus 80% when the Nasdaq index was only down minus 9%. Now if we jump forward to 2007 to 2024 and we compare the results during that time period of the Profund's SSO 2 times S&P 500 fund to the 2 times ULPIX mutual fund, which has a much higher expense ratio, if we compare the results, we'll see that the mutual fund version is not doing very well at all. So you'll see here in the purple is the ETF version. So it's basically underperformed the market since 2007 to 2015. So basically 8 years of underperformance. And then as the markets went up, it has outperformed the S&P 500. So 622% return versus 269% for the S&P 500 index. But if we compare it to the mutual fund version, the mutual fund version's only done 393% return. So much worse returns with the mutual fund. So in conclusion, should you invest in leveraged S&P 500 ETFs? I think Warren Buffett made some great points that leverage is not worth the risk. I think with the counterparty risk and the risk of having underperformance for a long period of time, however, those that want to maximize their performance, that want to take the risk, I think if you're doing a smaller amount under the right conditions, the right market conditions, the right time, leverage ETFs may be helpful. Thanks for watching. If you like this video, please press that like button. Also feel free to share, subscribe, and all that stuff. Also, I have a referral deal with Raisin. If you sign up via my referral link to any of the Raisin high yield products such as the high yield savings accounts, high yield CDs, or no penalty CDs, you sign up with my link with at least $5,000 and maintain the balance of $5,000 for 90 days, you'll get a $25 bonus. And the bonus goes up $5 for every $5,000, up to a $125 bonus. You get the super high rates, which are already some of the highest rates in the business. All FDIC and Credit Union Administration insured. You get the best rates and a bonus. So check for the link in the description for that.